Hello and welcome to Financial Intelligence. In this video, I want to talk about the impact of inflation on Social Security benefits. The reason that I have decided to talk about this topic is twofold. First, because of excessive money printing that has been happening after the pandemic, the inflation rate in the United States has picked up recently. Second, the way that the Social Security system is set up makes it more vulnerable to higher inflation. The main takeaway is that higher inflation is going to have serious implications for the Social Security program and its future. Before we get started, don't forget to like this video and subscribe to this channel and hit the notification bell so that you don't miss any of my future videos. I have organized this video into 3 segments. In the first segment, I am going to talk about inflation and show you the recent official data from the US government, which indicates that the inflation rate is picking up. In the second segment, I'm going to talk about the way Social Security funds are managed and why they are extremely vulnerable to inflation. And in the third segment, I'm going to be talking about how these two effects together are going to potentially reduce Social Security benefits available to its beneficiaries in the future. Part 1, inflation rate. Inflation is defined as the decline in the purchasing power of the currency over time. In other words, in an inflationary environment, the purchasing power of the money that you have today is going to be lower next year. This usually happens when the money supply, in other words, the amount of currency available to people, is increased without a corresponding increase in the volume of products and services available for purchase. It is easier to see this by looking at an example. Consider a very basic economy that produces 100 similar candies and is supported by a money supply of $100. Under these assumptions, each candy is going to cost $1. Now, if the government decides to increase the money supply to $200 with no change in candy production, each candy is going to cost $2. This example shows that increasing money supply creates inflation. The result is that the prices are going to go up and the real value of each dollar is going to decline in this economy. This is very much similar to what has been happening in the United States. The government has been printing money and increasing the money supply, which is going to result in inflation. In other words, the prices of products and services are going to go higher. We are already seeing the effect of this on the economy manifested in general uptick in the prices of goods. This chart shows you the consumer price index. The consumer price index measures the average change in prices over time that consumers pay for a basket of goods and services. As you can see, the CPI index has gone up by 4.2% in the past 12 months. I will add the link in the description box below so that you can check it out for yourself. Part 2, Social Security. Social Security is a federal program that has been set up to provide some level of support to retirees and disabled workers. This is how the Social Security system works. The government collects Social Security taxes from current employees and funds the program. Current beneficiaries receive monthly checks withdrawn from the Social Security fund. This slide shows you the money flow to and the money outflow from the Social Security Fund. For more details, you can check out my previous video on how Social Security trust funds are managed. One important point to note here is that this trust fund, by law, can only invest in US Treasury bonds. United States Treasury bonds are debt securities issued by the United States Department of Treasury to help pay for the US government's borrowing needs. In other words, investing in US Treasury bonds is equivalent to lending money to the US government. The main takeaway here is that the Social Security Trust Fund has an obligation by law to invest only by lending money to the US government. The original reasoning behind this was that US government debt is one of the safest investments because they are backed by the full faith and credit of the United States government. Therefore, the lawmakers wanted to make sure that the Social Security Trust Fund does not invest in risky assets such as stocks. This was a great idea at the time because the US government was not in the habit of printing money. The challenge nowadays is that the Social Security Trust Fund is lending money to someone who has the power to print money. The US government has been expanding the money supply drastically, thereby devaluing its own debt obligations. In other words, US Treasury bonds. This devaluation directly translates into a decline in the total real value of the Social Security Trust Funds because they are composed solely of US Treasury bonds. Part 3: Social Security and Inflation. The data coming out of the Social Security Administration already shows that the Social Security program is operating at a deficit. This means that the outgoing money stream from the trust fund, in other words, the payout to Social Security beneficiaries, is larger than the incoming money stream, in other words, the Social Security taxes collected from employees. What this means is that the Social Security Trust Fund is getting depleted even without taking into account the impact of inflation. Now, if you layer in the impact of inflation, the rate at which the Social Security Fund is getting depleted is going to be even higher. That is because the real value of the Social Security Trust Fund declines by inflation. As if this was not bad enough, there is another factor that makes the situation even worse, and that is the fact that the US government is considering increasing Social Security benefits to retirees to compensate them for the impact of higher inflation. This is a triple whammy for the Social Security program. What ends up happening is that this trust fund is going to be depleted very quickly, as predicted by the official forecasts coming out of the Social Security Administration. They have announced that the Social Security Trust Fund is going to be completely depleted by 2034. I'm going to add the link to their prediction in the description box below so that you can check it out yourself. This is going to have drastic implications for the future beneficiaries of the program. I'm going to discuss these implications in my next video, so stay tuned. I hope that you liked this video. Don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you don't miss any of my future videos. Take care and thank you.